Hey guys, my name is Ryan, and today I want to make your life easier when it comes to investing. This strategy is almost idiot-proof because there's practically no skill needed. I'm not very smart and I can do it, so I guarantee that you can too. You probably see so many different videos on YouTube about what you should be investing in, and it can be overwhelming to see all these different companies, options, and methods. But I want to tell you what is arguably the easiest, safest, and best long-term strategy for the majority of people. I've mentioned them before in previous videos, but index funds are such great investments because they require very little work and give you some of the best returns that you can get. By following this video, you'll be able to have a set it and forget it strategy that beats over 90% of individual investors over the long term, and no one can really complain about that. So in this video, we're going to be talking about what index funds are, why they're so great to have, and the only 3 index funds that you need to buy for life. But another thing that I want in my life are friends. And for you to hit that like button and subscribe, because I would really appreciate it, and it really helps me and my channel out with the YouTube algorithm. And also watch this video until the end. Whether you're new or experienced, I think that index funds have a place in every investor's portfolio. But what is an index fund? To break it down, let's imagine that you're in school and you and your friends are doing a fundraiser selling pizzas. For the fundraiser, you buy a bunch of pizzas with a variety of toppings so that people can choose whatever they like best. But now, let's talk about the money, and let's say that you're really confident that a lot of people will buy pineapple pizza, and you tell your friends that all the money that you make selling pineapple pizza is yours. If you and your friends sell a lot of pineapple pizza, then that's great, because then you get to take all those profits. But there is a possibility that you'll barely sell any pineapple pizzas at all. If that happens, then you don't come out with any money because you put all your eggs in one basket. Arguably, the smarter idea would have been to wait until the fundraiser is finished and take a portion of all the money that you and your friends made together. This would include the profit from pineapple pizza, but also from cheese, pepperoni, supreme, chicken, mushroom, and everything else. Instead of betting on one type of pizza, you are casting a wider net and can get a slice of the total profit you made from all the pizza you sold. But just like this pizza example, index funds work the same way. Index funds are a collection of investments that you can put your money in, and you essentially own a percentage of the entire collection. Just like taking a portion of your pizza fundraiser profits, you are taking a portion of whatever collection you are choosing to invest your money in. There are some really big indexes that contain a lot of companies inside their collections, like the S&P 500, the Nasdaq, the Russell 2000, and so on. But there are also smaller and more specialized indexes for anything you can think of. Technology indexes, real estate indexes, travel, healthcare, the list goes on. Make sure to watch until the end of this video to find out which indexes are best for you to invest your money in. The point is that you are putting your money towards larger groups of companies instead of individual ones, and these groups can be as broad or narrow as you like. Now that we have a better idea of what an index fund is, let's talk about why they're so great to have in your portfolio. The first reason why index funds are so attractive is because you will statistically make more profit in an index fund versus individual stocks over the long run. As I mentioned earlier, there was a study from 2001 to 2016 that showed that 90% of active fund managers underperformed their benchmark index. In other words, they could not beat it. These active fund managers are people who have studied finance and economics and are well-established professionals in their field. And if 90% of them were not able to outperform an index, why should I think that I can do better as a random guy? Speaking of active fund managers, another benefit of index funds is that you don't need these people at all, so index funds are cheaper to own in the first place. The cheapest thing that you can do is to smash that like button and subscribe though. But before we continue, a quick disclaimer is that I am not a financial advisor or a financial professional in any means. I'm just a guy on YouTube and these are my opinions for entertainment purposes only, not financial advice. When you invest in what's called a mutual fund, you are essentially buying a fund that employs professional stock pickers and managers that are actively doing research to try to beat the market. While you might be thinking, hey, that's great if I have a team of professionals trying to help me, the downside in investing in mutual funds is that it comes with very high fees, because you have to pay these people to do their job. Also, keep in mind that although these are very intelligent investors and professionals, the majority of them do not beat the index in the first place. But with an index fund, you are investing in a fund that is passively managed, because all it has to do is keep track of a specific index. These are automatically adjusted over time and have very little maintenance because they essentially run on autopilot. As a result, index funds have much lower fees than mutual funds, so they are cheaper to own and usually achieve better results. Who wouldn't like that? With index funds, you pay lower fees for a better return compared to mutual funds, and to me, that's a win-win. But keep watching this video until the end so that you can learn what index funds will help you win-win in your portfolio too. Hey guys, it's Editor Ryan here. So the footage you're about to see somehow got corrupted and I had to delete it. So your boy had to put on the same clothes and film the whole thing again. So please give me a like because I had to film it twice. The third reason why index funds are great to have is because they give you easy access to what's called diversification. Like the beginning example with the pizza fundraiser, it definitely is riskier to tell your friends that all the money that you guys make selling pineapple pizza is yours. Your money lies in the hands of how much pineapple pizza you guys sell, and that is pretty risky to put all your eggs in one basket or bet on one horse. It's a lot safer to wait until the fundraiser is over and then take a percentage of all the profits that you guys make. This is essentially what diversification is. When you diversify what you're investing in, you have much more of a cushion to fall back on in case things go wrong. As a hypothetical example, let's say that you invest in an index fund that has 10 different companies inside it. After 1 week, let's say that 3 of those companies didn't do too hot and they fall in price. Well, that's not great news. The other 7 companies inside the index had a good week and went up. And as a result, the overall index went up altogether. This is the power of diversification. You are investing in groups of companies instead of individual ones, so you are averaging out all the companies' results. While this hypothetical index fund had 10 different companies in it, there are some indexes that have hundreds or even thousands of companies inside. Talk about a broad net. And as mentioned before, there are so many different types of indexes for any type of market or any type of industry that you want to, so the possibilities are endless. This makes your life a lot easier too, because instead of buying multiple different companies to diversify, all you have to do is buy an index fund and voila, you're done. But don't just take my word for it. Warren Buffett, who is one of the richest and most successful investors in the world, says that index funds are going to be the best choice for the majority of people. By investing in an index fund, an investor that knows nothing can actually outperform most finance professionals. And if index funds are good enough for one of the wealthiest people alive, I think that they'll be great for you and me too. But now, let's talk about what index funds you should be investing in. There is a very famous strategy called the 3-fund portfolio, and it is made up of 3 funds. Well, duh. The 3 parts of this portfolio are the US stock market index, the international stock market index, and the bond market index. Now, every brokerage will have their own version of these indexes, but for this example, I'm going to be talking about Vanguard because I personally use Vanguard myself. If we're looking at these Vanguard index funds, then the US stock market index is VTSAX, the international stock market index is VTIAX, and the bond market is VBTLX. The names in the parentheses are technically what's called ETFs, but they track the same kind of index as their fund counterparts. The 3-fund portfolio is a really popular way to invest your money because it gives you the broadest diversification with the cheapest cost that you can get. This is because each of these funds track different things and don't overlap too much, so you know that you're getting super broad coverage. And like how we talked about diversification earlier, if anything happens to one of these funds, then you still have the other 2 to balance everything out. The last thing we'll have to talk about is how much of each you'll have to buy. Stocks are traditionally more risky because they're more aggressive and more volatile, but you have a higher chance at growth. Bonds are traditionally more of a safer investment, and although they don't grow as much or as quickly, they're used more like a safety cushion and a very comfortable investment. But the rule of thumb is that your age will dictate your stock and bond ratio in your 3-fund portfolio. If you're like me and you're in your 20s and you're far away from retirement, you can be more aggressive and own more stocks. But if you're closer to retirement, having less stocks, more bonds, and being less aggressive is probably going to be a safer bet. I've seen people do a breakdown of 70% US stock market, 20% international stock market, and 10% bond market in their 20s and 30s, but you can adjust these percentages however you'd like. For me personally, I'm in my 20s and I want to be as aggressive as possible while I still have the power of youth and time on my side, so I'm 100% in on stocks. I currently do not own any bonds or bond indexes at the moment. I probably will be buying some bonds and adjusting my portfolio as I get older, but that'll be a conversation to have with future Ryan. However, this 3-fund portfolio will be the best bet long term for the majority of people. If you buy these funds consistently and just hold them for years and years, you will be set after rinsing and repeating this process for decades. Don't think about trying to time the market and buy when everything is crashing down. If you buy and hold consistently over a long period of time, everything will average out in the long run. By investing in the 3-fund portfolio over the long term, you will be well diversified and have a solid portfolio that you should be able to retire with, and it's so easy to do. You set it and forget it, invest money every month for years and years, and that's it. You're done. I hope this video was helpful in explaining the power of index funds and how the 3-fund portfolio is realistically the only thing that you need to invest in. I personally follow this portfolio and put a lot of money in and hold a big chunk of index funds myself. While I do buy other stocks too, the 3-fund portfolio is a big chunk of my investments overall. If you enjoyed this video, please smash the like button because it really helps me out and it lets YouTube know that people enjoy content like this. If you want to see more videos on personal finance and investing in the future, please subscribe to my channel too. Please leave a comment down below if you had any thoughts or questions about anything I talked about, and let me know what you think about the 3-fund portfolio. If you want to get started in investing and want 2 free stocks with one of them valued up to $1,400, click the link down below for Webull. But if you're interested in fractional shares and want $10 free, click the link down below for M1 Finance. Thank you so much for watching, and make sure you stay financially fashionable.